With the coronavirus sweeping America, senators are accused of insider trading. What exactly happened? And are the senators really responsible? Welcome back to America Uncovered. I'm Chris Chappell. Gosh, folks, remember January? When you could do crazy things like eat a meal at a restaurant, go out to see a movie, or take public transit, all without feeling like you were the protagonist in a Mad Max movie. It turns out that more happened back in January than just partying and movie watching. On January 17th of this year, former Congressman Chris Collins, a Republican from New York State, was sentenced to 26 months in prison and a $200,000 fine after being convicted of insider trading. Former Representative Collins was the first member of Congress to be indicted for insider trading since 2012. That's when Congress passed the Stock Act, which banned insider trading by members of Congress and their staff. Specifically, the law states that members of Congress may not use non-public information derived from such person's position or gained from the performance of such person's official responsibilities as a means for making a private profit. Fast forward to earlier this year. On January 24th, the chairs and ranking members of the Senate's Health, Education, Labor, and Pensions Committee, as well as the Senate Foreign Relations Committee, hosted a closed-door, all-senators briefing from Trump administration officials on the coronavirus. Other people at the briefing included Robert Redfield, the director of the Centers for Disease Control, and Dr. Anthony Fauci, the head of the National Institute of Allergy and Infectious Diseases. According to a statement released by senators who served on the two committees, we are monitoring the outbreak of a novel coronavirus closely and are in close communication with United States government agencies on actions and precautions needed to prevent further spread of this virus. But a few senators may have taken some additional actions and precautions, like selling stocks before the market crashed. One of those senators appears to be Richard Burr, a Republican from North Carolina. Senator Burr is the chairperson of the Senate Intelligence Committee, which means that he's been receiving daily briefings about the threat posed by the coronavirus. He also voted against the Stock Act in 2012, but that's probably just a coincidence. On February 27th, the same day that President Trump said that the coronavirus would hopefully disappear in April, Senator Burr gave a more dire assessment of the virus's threat when he appeared at a private luncheon organized by a North Carolina group of businesses and organizations. According to leaked audio of Burr's comments, Burr told people at that luncheon that the coronavirus is much more aggressive in its transmission than anything we have seen in recent history, and that it is probably more akin to the 1918 pandemic that killed 50 million people. Then, on March 19th, a story in ProPublica found that Senator Burr had unloaded between $628,000 and $1.7 million in stock in 33 separate transactions over the past several months. From a financial point of view, the stock sell-offs would make sense. An estimate by Roll Call in 2018 put Senator Burr's net worth at just $1.7 million, meaning that if the senator's stock was to plummet, it would put him in the kind of financial jeopardy faced by, everyone else right now. The condemnation from across the political spectrum was swift. Alexandria Ocasio-Cortez called on the senator to resign, while Senator Burr's North Carolina colleague, Senator Thom Tillis, tweeted, "Given the circumstances, Senator Burr owes North Carolinians an explanation. There needs to be a professional and bipartisan inquiry into this matter." Perhaps the most surprising condemnation, however, came from Fox News pundit Tucker Carlson.
He dumped his shares in hotel stocks so he wouldn't lose money, and then he stayed silent. Now, maybe there's an honest explanation for what he did. If there is, he should share it with the rest of us immediately. Otherwise, he must resign from the Senate and face prosecution for insider trading. There is no greater moral crime than betraying your country in a time of crisis.
The senator released a statement on Twitter defending his stock sell-offs. I relied solely on public news reports to guide my decision regarding the sale of stocks on February 13th. Specifically, I closely followed CNBC's daily health and science reporting out of its Asia bureaus at the time. Understanding the assumption many could make in hindsight, however, I spoke this morning with the chairman of the Senate Ethics Committee and asked him to open a complete review of the matter with full transparency. Yes, if there's one thing for which Senator Burr is likely to be remembered for, it's his transparency. Senator Burr isn't the only senator facing scrutiny for the abrupt sale of stocks. Senator Kelly Leffler, a Republican from Georgia, has also come under fire for an unusual number of stock sales. Senator Leffler's first reported sale of stock was on January 24th, the same day as the Senate's private all-senators meeting about the coronavirus. She even tweeted after the meeting, "Appreciate today's briefing from the president's top health officials on the novel coronavirus outbreak." Reports indicate that Senator Leffler engaged in 29 stock transactions from January 24th until mid-February, all of which were sales. Then, on February 14th, she bought stock in Citrix, a company that provides web-based services, including teleconferencing, and Oracle, a computer technology corporation. But I'm sure that's all a coincidence. Just a nice big coincidental coincidence. Following the initial report of the stock sales, Senator Leffler tweeted, "This is a ridiculous and baseless attack. I do not make investment decisions for my portfolio. Investment decisions are made by multiple third-party advisors without my or my husband's knowledge or involvement." In case you're wondering who her husband is, he's Jeffrey Sprecher, the chairman of the New York Stock Exchange. According to CBS News, Sprecher himself unloaded $3.5 million in shares in the company he leads, which owns the New York Stock Exchange. Since that sale, shares in that company have plunged nearly 25%. Again, I'm sure it's all just a coincidence. Senator Leffler then went on CNBC to clear up any lingering confusion about her stock sales.
The third-party advisors are the same ones that many Americans rely on for their investment advice. I have no involvement in these decisions. I don't have conversations with them about any of this. And I should note that I have 20 years of investment experience where I'm accustomed to managing through sensitive information, and I have always adhered to the letter and the spirit of the law, and I'll continue to do that.
According to the Hill newspaper, the sale of Leffler's stocks were worth at least $1.2 million. But don't worry. Unlike Senator Burr, there wasn't any danger of Senator Kelly Leffler going broke. According to Vanity Fair, she's worth approximately $500 million. In a way, that makes her story about the third-party advisor more plausible. Who has time to worry about $1.2 million when you're worth $500 million? $1.2 million is what she finds under her couch cushions. But what makes the public so angry is that up until a few weeks ago, Senator Leffler was downplaying the seriousness of the virus. As recently as March 10th, Leffler took to Twitter to share her optimism.
The good news is the consumer is strong, the economy is strong, jobs are growing. Our president has done a fantastic job making sure that we're in the best position to manage through this situation.
Then there is the case of Republican Senator Jim Inhofe from Oklahoma. It's been reported that between January 27th and February 20th, he unloaded $400,000 worth of stock. Senator Inhofe's office tweeted a statement in response to the report and the public outcry. The New York Times allegations are completely baseless and 100% false. I was not at the briefing on January 24th. I was meeting with pro-life kids from Oklahoma here for the March for Life and the new nominee to be the U.S. ambassador to Tanzania. I do not have any involvement in my investment decisions. In December 2018, shortly after becoming chairman of the Senate Armed Services Committee, I instructed my financial advisor to move me out of all stocks and into mutual funds to avoid any appearance of controversy. My advisor has been doing so faithfully since that time, and I am not aware of or consulted about any transactions. Finally, there's the case of Democratic Senator Dianne Feinstein of California. It was reported that between January 31st and February 18th, she sold between $1.5 million and $6 million worth of stock. According to a statement she released after the report surfaced, "During my Senate career, I've held all assets in a blind trust of which I have no control. Reports that I sold any assets are incorrect, as are reports that I was at a January 24th briefing on coronavirus, which I was unable to attend. Under Senate rules, I report my husband's financial transactions. I have no input into his decisions. My husband in January and February sold shares of a cancer therapy company. This company is unrelated to any work on the coronavirus, and the sale was unrelated to the situation." So her defense is that her husband did it. But if her husband profited off her information, that would still violate the law. Former Congressman Chris Collins got in trouble for telling his son to dump stocks. But Senator Feinstein claimed to have no input into her husband's financial decisions. And to be fair to Senator Feinstein, Barron's did point out that the biotech stock she sold was at a low point, meaning that its sale wouldn't be out of the ordinary. And who knows, maybe she and her husband don't speak to each other. And to try to be as fair to Senators Leffler and Inhofe as possible, it is plausible that an investment manager would make decisions on behalf of their client without consulting them. After all, that's their job. And yet, you're not alone if you think something awfully fishy is going on here. 4 senators tasked with safeguarding America's well-being get wind that things are about to take a nosedive. One claims he's just reacting to market news, he being the head of the Senate Intelligence Committee. And the others claim to have zero contact with their financial advisor whatsoever. And yet, they all wind up saving hundreds of thousands or even millions of dollars just before the stock market collapses. Yeah, I know, it's probably just a coincidence. Ultimately, where do things go from here? In order to indict the senators in question, the prosecutor would have to prove that they instructed the trades to be made based on non-public information that they got through their government positions. That's hard to prove. And so, they're all likely to stay in office and weather the storm of public criticism. After all, the public has more pressing things to worry about. Boy, wouldn't you just love to go back to simpler times, like 2 months ago, when you could go outside safely, and when getting caught for insider trading would mean you'd actually get prosecuted. Those were the days. So how do you feel about the trades those senators made? Leave your comments below. And remember, America Uncovered is supported mainly by viewers. So visit patreon.com/AmericaUncovered. Contribute $1 or more per episode. We rely on your support to help us keep making great episodes. Once again, I'm Chris Chappell. Stay safe out there, and thanks for watching America Uncovered.